Good afternoon. How's everyone doing? We've officially moved from the morning. I can say afternoon now. Want to really just talk this morning or this afternoon about what FCI is, talk about our network, how that operates. And what you've heard so far this morning has been around opportunities, issues, ways of potentially doing business. And what I want to show you is there is a way to do business today. And the importance of this is it's been tested more than 55 years. And we have the ability to plug Gift City, the banks that are here, into this network almost immediately. There's a little bit of work that needs to be done. There's no question from that perspective, but I want to really focus on the fact that what FCI is a network. And we are a network of open account trade finance. And that word network is a very important word in FCI because it's more than being an association. An association is similar to this room. We're in this room, we can talk to each other, we can negotiate deals, but where the value really comes is in the network. And just to share a story from last night, I had the opportunity to have dinner with Indian XM and the team, and celebrating, which I didn't realize, their very first FCI export transaction from Gift City. So one, just congratulations on that. That's a huge win. But as we left the restaurant, we're in the taxi for me to come back to the hotel, and these were left at the table at the restaurant. Hotel calls and says, we found someone's glasses. We call back to the hotel. Someone from the team was still there. They were able to pick my glasses up and bring it to me this morning. That's the network, right? In an association, I couldn't have done that. But in a network where I knew somebody, I trusted somebody, I didn't worry about turning the taxi cab around to go get my glasses. I was able to rely on a network to get it done. That's the value. And it's also important because I couldn't see my notes this morning if I did not have them. So I think it'll be a little bit better presentation from that perspective as well. So let's talk about FCI. I think it's important to talk about what this network is. And I want to validate for you that it truly is a network that works today. In fact, it's been around for over 55 years. And it's tested, it's true. Farther in the presentation, you'll get to see some of the data points that also validate that. So this is our network. This is our map of the network from around the world. And you'll see fairly good representation. Something that is a little mistaken a little bit is that number 86. It's sitting there in South Asia. Most of that 86 is actually up in China. It's up in the more northern part of Asia. Where we need to really fill in our gap from an FCI perspective is in this market. It's in the Southern Asia market. It's from India across Bangladesh into Vietnam, into Cambodia. That's where the opportunity lies. A lot of what I'll talk about today, which again is the validation, is trade flow and business flow that we've seen Europe, America for the most part, although India has been very successful in this market. We have Ravi from India Factory who's shown that this product works in India. Now, there's some real challenges that he has and you have as a finance companies from a cost of capital perspective. And I'll talk about that as well, because I think it's very important that that gets addressed. But first, in terms of what FCI is, FCI is 400 banks, financial institutions across 90 different markets. Those 400 banks have a constitution. That constitution then drives our rules. Those are rules that we own in FCI. All of our members that are members of FCI own those rules. They're ours. They're not governed by anyone else. Those groups then come together and create a board, an executive committee. That executive committee then hires me to run and manage this on a day-to-day basis. So strategically, there's a board that's overseeing FCI in its direction, and I'm tasked with really taking that to the market and making sure that we're operating in the way that we should. So when we look at what elements make up FCI and what makes up our business model, there's really 3 or 4 pieces to it. First and foremost, as I said, is the Constitution. That is what all 400 banks that belong to our membership, it's been around for over 55 years, it's what we believe in, it's how we operate. That Constitution then created our general rules of international factoring, or GRIF. Those rules are what we live and die by every single day. The proof that that works is that over 55 years, FCI has only had 8 arbitration cases between its members. 8 over 55 years. Why is that? Well, it's because of the fact that all of these members are in this association together, but more importantly, being in that association, they have a network where they operate together every single day and work with each other. The final point in the value proposition for FCI, and it's something that, with the IFSCA team, I would definitely be talking about over the next few days, is our capacity building. Now, we have an educational team and an advocacy team that spends 100% of their time going into market, doing programs and presentations. We were in Mumbai last year a few times. I was in Zimbabwe personally last year doing one. This is something that we do all across the market, basically where our members come to us and say, we need some assistance, we need some education, we need some oversight, we need to understand more about open account trade, what it is, the value of it, and how it works. So the product itself is two-factor business, or what many people would call, Andre mentioned this as well, the four-corner model. I'm a huge believer in the four-corner model. In fact, it's the reason that I've come back to FCI. So, as was mentioned, I'm a 30-year banker is my background. I still have a hard time believing that and saying that when I say the word 30, but it's true. I looked back at the dates, and it's actually 30 years. But I exited the industry, and FCI, as Peter was retiring or thinking about it 2 years ago, called me and said, you understand what we're doing. You have a vision here of what this should look like. And unfortunately, we've gotten away from the four-corner model in FCI. And we had started to go down the path of the three-corner model. So the difference, just for everybody in the room, the four-corner model, as Andre showed as well, you have a seller, exporter, you have a buyer, importer, and you have each of their banks. So that represents the four-corner model. What's happened over the past 10 or 15 years, unfortunately, is large buyer programs with large banks representing those buyers have moved to a three-corner model and has pushed that funding from a large buyer into different markets. The problem with that model is it doesn't provide support to the supplier, ultimately. And we'll talk about that in a few minutes in a later slide, but just to give you an overview, think about the seller to buyer transaction, purchase order to final payment. That's anywhere from a 60 to 180-day cycle, depending on distance and product and distribution and terms that have been accepted. In most cases, in supply chain finance, three-corner model, it only addresses the last 30 days or 60 days of the transaction. As we saw earlier, 90% of India is made up of small, medium-sized enterprises. That's who needs the working capital. They don't need it when the product has been received in a port in Los Angeles. They need it when they have the purchase order on the front end. And the other slide that I thought was very interesting for Mr. Shree from IFSCA, or from Gift City, is 95% of open account is left unfunded. That means your SME, your middle market enterprises are not getting the funding that they deserve earlier on. If we get back to that four-corner model, where there's a local bank next to the local supplier, local exporter, that brings value to that exporter. Because the import bank that's across the ocean in the United States or Mexico, they're not going to finance the supplier or the exporter in the local market. So it's so important that we get back to that four-corner model. Why do I also think there's value in this, and this is where we need to get into some real statistics and get away from just theory, and that is that when banks were asked, where's the opportunity for growth, and do they think in 2024, so last year, that there was going to be growth, 81% said yes. My balance sheet is going to get bigger. More importantly, and I know it's hard to see on this side of the room, but 27% then of those banks listed the number one product for growth as accounts receivable finance. So banks recognize the need for that. That's the reason we're in this room today. This event was put together fairly quickly, and the room's full of bankers that have an interest in how this works. So this is proof that it's more than theory. This is proof that the data supports it. In this room today is proof that there is a way to do this and there's a way to take it forward. In terms of factoring the growth, so again, from a data perspective, let's put numbers to this. Someone says, well, factoring is an old product. It's not a growth product. If you look at this chart and you can say, well, it only grew 4% last year compared to the past, so it's slowing down. You can look at it one way. The other way to look at it is what's on the bottom of the slide. That manufactured trade in the same year actually decreased almost 5% during that same time period. So factoring grew 4%, while manufactured trade in the same time frame reduced almost 5%. So what that's showing us is factoring open account finance is valid, it's real, because it's outpacing trade. And for me, if I have to have a KPI personally, that's my KPI. Right? As long as I see that the factoring industry and open account finance is growing at a pace faster than manufactured trade, then I'm doing my job. We're doing our job. And in India, bringing it back to India, we answer the solution or the question or the issue of 95% of trade not being supported from financing. This is the opportunity. This is the proof that it does work. The other thing that was mentioned, I thought this was ironic, and obviously there's been a lot of U.S. issues in trade the past 15, 20, 30 days. I'm from the U.S., obviously, but I live in the Netherlands, so I can kind of divorce myself a little bit from that. I can say I'm Dutch now. But the reality is this isn't just a U.S. issue. A statistic that was done on voting in 24 is over 2 billion people went to vote last year in economies all over the world. And in that voting, in most markets, there was a significant shift in markets. So it's not just a U.S. thing. I think we're hearing about it because somebody has a good microphone and is able to talk a little bit more. But it's more than just a U.S. issue. And that, to me, is an opportunity. There is a shift in trade that's going on. And again, I don't like to talk about theory. I like to show actual numbers. And to me, this is the example for India. And when you look at this chart and you see what India has done over the years, and I know it's hard to see from the back, so let me highlight India. 1980, India wasn't up on the chart for the most part. As we're moving forward 10 years, 20 years, 30 years, moving out into the future, another 20 or 30 years, you see India is going to be one of the top markets from a trade perspective. There's an opportunity. If we look at history and we look at Turkey, I think is a really good example to this. I could put Turkey up on this chart going back in the 50 years prior, and you see this exact same story. So the story that's being told right now in this room about India, we saw in Turkey 30, 40, 50 years ago. When we look at the numbers and the statistics, Turkey is the leader in open account financing. Why is that? Why was that possible? One, leadership. The leadership in the market, those banks, those factors came together, they put competition aside, and they said, let's figure this out. Exactly what's happening in this room today. I'm a firm believer in, a high tide rises all boats, right? So if we're all in this together in our own boats, we can do all of this together. That's the opportunity with this. And again, I like facts versus just theory. And to me, that Turkish example is what the opportunity that we see today here in India. It's a great opportunity for us. So again, proof that change can happen and it matters from a regulatory perspective. So being a 30-year banker, I know how to work with regulators, especially on the international side. We always seem to be very attracted to regulators, or they were attracted to us. But it's important to have that relationship with that regulator so they understand your business. They become the promoter of your product if they understand it properly. And as you can see in 2020, we saw a growth curve. We saw this within FCI numbers at this point in time. Now maybe it was luck to some extent, but for me, this is a point in time that showed that, okay, there was a change that started to happen from a regulatory perspective. We saw volumes start to pick up within our own network. Now this volume is still extremely low. It's nowhere near where it needs to be. So we need to continue to work with RBI and with IFSCA to come together and talk about how do we address export finance? How do we address import finance? One bullet point that I really want to focus on, and you'll see it a little bit later in some of the quality slides that I have, is today you're having to hold 100% of your capital for the export transaction under open account. If that same transaction is being done under a letter of credit, I think was it probably 50% that's held in capital. So you have a 2 times advantage doing an LC versus open account. But the reality, as you saw earlier, 95% of open account isn't being supported with working capital. With an open account solution put in place where you are using a bank in the four-corner model to provide that risk protection of the transaction, that is as good as an LC. And again, I'm going to show you statistics here because I'm not a theory person. I'm about statistics. You're going to see that in the proper structure of open account, it is equal to, in some cases, better than an LC from a risk perspective. So for that reason, the cost of capital allocation for the export market here in India should be the same. Open account transactions structured and backed the right way, transaction with LC, you should have the same benefit under both structures. It's beneficial to you, it's beneficial to your client. And I am not someone that's saying get rid of letters of credit. I believe that all are needed. Open accounts needed without finance, LCs are needed, open account backed by banks is needed, and in some cases there may be prepayment, pre-shipment type deposits that are needed as well. All of those have to be together, but for them to be together, they need to be an equal playing field. And today it's not. LCs are held to a different standard than open account, and that's a huge opportunity for you in India. This talks a little bit about some market studies that have been done. Again, this is outside of FCI, so I like bringing this up just to show statistically where the opportunity is. It says 15% from a growth perspective. I think it's much higher than that. Again, we go back to the fact that 95% of trade is not covered for open account finance. If we can just capture 5% of that, we're easily going to hit that 15% growth market because the base today is so low. So I actually think this number is going to be much, much higher than that. Again, I don't like to be a theory person, but my theory is that this is something that we definitely will surpass over time. So to talk about the products of FCI in terms of what we do and what we support, many of you here in this room are familiar with this, but ultimately the core of everything that FCI does, and it's similar to what Andre talked about, it's a bank-to-bank transaction. That's what FCI is about. We're a technology provider to our banks. We're fully digital between our banks. The banks have the ability to send a transaction within seconds between each other to get credit approval on a transaction, and then ultimately put the transaction through the network and through the product. The way it works is if you're here in India, you have an exporter, that exporter is selling a product to the United States. You're able to, through the network, immediately contact someone like a Wells Fargo and say, I need 10 million in coverage on Amazon. You can get that response back fairly quickly, depending obviously on the import bank and how fast they do respond to you. But you can then take that now to your exporter, use it, you're backed by FCI, you're backed by the import bank, manage that transaction, fund the transaction, and on the other side of the water, there's the possibility that Wells Fargo ultimately does financing based on that transaction as well, depending on how the two FIs, the two financial institutions, work together. But the core of everything that FCI does, it is in that four-corner model. It's a back-to-back transaction where the export factor is relying on the value of that import factor. So, going back to my three-corner versus four-corner and saying, well, why does it matter? If you have a strong enough bank in the model, why do you need a partner on both sides? And to me, I go back to and answer it with, it's my arbitration. 8 arbitrations that we've had over 55 years. Why is that? What's the reason for it? It's because when there's a problem in this financial transaction, the import factor is going to know it. That import factor is dealing with the buyer every single day, not just on your transactions, but every other transaction and payment that they're dealing with. If that buyer has a problem with the transaction, the shipment's late, it's still on the water, we opened it up and there were 9 cartons versus 10. We put the product on the shelf and there were white t-shirts versus blue. Little things like that can have a huge impact on your payment 60 or 90 days later. If you have a local bank or import factor involved in the transaction, they know there's a problem immediately. They're talking to that payables clerk at Walmart. The payables clerk says, yeah, I'm going to pay that bill, but I've got a little bit of an issue here. That import factor is immediately going to come back to the export factor and say, we have an issue. Now, the importance of that isn't just on that one transaction that's sitting there outstanding, but it also is alerting the export factor that all the transactions that are coming behind that, there's an opportunity for you to work with the seller, work with the exporter to make sure this isn't a bigger problem than what it is. So again, that's the value of this network. Going back to having someone locally can go and pick up a pair of glasses for you. That import factor can locally talk to the bank, talk to the importer in market, and find out what the situation is, and hopefully get those pair of glasses back to you at the end of the day. So I mentioned the reverse perspective. So this is FCI, right? It's the exporter. In this case, this was from last week, so I was in Bangladesh last week. This product is going out to buyers all across the world. In the reverse transaction, it's the same transaction. The only difference here is from a marketing perspective. The underlying transaction is the same. I was having this conversation with one of the banks in Singapore last week, and they said, yes, but in the buyer transaction, the invoice comes from the buyer. And I said, well, it may come from the buyer from a marketing perspective, but from a legal perspective, that invoice came from the seller. It always originates from the seller. The security agreement that protects the bank and the seller is in that seller's market. It's not in Singapore where the buyer or the buyer's bank is. So it's very important to realize that even though we say it's a reverse transaction or supply chain finance or payables finance, it always starts as a receivable. And the value within FCI is that when that Taiwanese import factor has a buyer that's interested in some kind of supply chain finance, that Taiwanese factor can come to India and say, I have this buyer, they have a supplier that's in your market, they are looking to enter our supply chain finance program led from Taiwan. You then can get involved to help the exporter to secure the transaction. Tax has been talked about quite a bit here, and one of the issues in doing direct supply chain finance out of market is the withholding tax is missed in many cases because that income and transaction is happening in Taiwan, but in reality the transaction's here. It started here in India. So again, there's an opportunity and a value from a tax government perspective. There's an opportunity from a security perspective to make sure that that invoice has been secured properly in the local market. And then there's a servicing and liquidity opportunity with the two banks, the one in Taiwan and the one in India, being able to work together to bring the liquidity and the financing to all parties. So for me, this goes back to the value of that four-corner model and being able to bring partners together because you're local to where that seller and where that buyer is. One other thing that I wanted to highlight, and this is not a product that's used that much in FCI today, and the reason for that is that in many cases, FCI is in a very niche part of the bank. So most banks have factoring, they have LCs, and they have foreign exchange and payments in three completely different groups. When I ran an international bank in the US, I was no different. I had three different department heads that ran all three of those. The good thing is I had an understanding for all three, and so I forced them to talk with each other, and do business together. But that's an opportunity for them to work together. I was with the bank last week and was meeting with that bank. They're one of the biggest banks in our network. They represent 10 different countries around the world. And in the conversation, we're only the factoring team. We didn't have the trade team. We didn't have the FX team. We didn't have the distribution team. So during the meeting, I asked, I said, do you mind or do you have anyone from your distribution desk that's available? And I said, well, we do. He's just down the hall. Let's bring him in. So he comes into the meeting. And I showed him this slide. And I said, what FCI does every single day is distribution finance. An export factor has risk in the transaction. They're using our network to lay that risk off to an import factor. That is the definition of distribution finance. 20 years ago, I used the FCI network when I was at Bank of America. I would lay off between 100 and 250 million US dollars every single month with SunTrust, Wells Fargo, and other banks that were in the US using this model because we had the legal framework, we had the technology then, even back then, to do that literally with a few clicks of a button. So as you go back to your banks and you start talking about this business of open account finance, make sure you're bringing it mainstream. Don't just talk to your factoring groups, don't just talk to the open account teams. Make sure you're bringing in all of your product teams to understand what this opportunity is because it's a significant opportunity for you, especially if you start looking at import finance here in India. At some point, you are going to need to use other banks to leverage their balance sheet and your balance sheet because you're going to have some transactions that are just too big for your own balance sheet. And using this distribution model is a significant win for all parties. So I mentioned at the beginning of the presentation that I'm about numbers, not theory. And for me, if I want to compare my product to the other products that are out there, I've got to be able to prove and justify the quality that we see in the portfolio. So this is a slide that represents FCI's total portfolio. It's our global portfolio. I'm not handpicking better countries. This is every transaction that's in the FCI ecosystem over the past few years. And I purposefully leave COVID timeframe up here because that's unfortunately for all of us that we all lived through. It was one of the worst times that we had to live through, personally, professionally, etc. Even in that worst case scenario, FCI's dilution peaked at just under 7% at the worst point in time. So dilution, just to take a step back for everyone in the room, you have a $100 US invoice, and if you only collect 99 of 100 of those dollars, you've got a 1% dilution. If you collect 95 of the 100, it's a 5% dilution. And most open account portfolios around the world, depending on the portfolio, that average dilution can be anywhere from 5% to 15% of receivable dilution. And that's why most of us in this room only advance 75, 80, 85% against that asset. That's just good loan to asset ratios, right? Again, when you look at the quality of the FCI portfolio, our dilution is only 3% across the entire network. And again, I go back to the value of that four-corner model, that because you have a bank or a financial institution in the local market where the buyer is, they're finding an issue before you are ever going to know about it as an export bank or an export factor. You're preventing dilution in the network. Now, does an invoice dilute 100%? Does a invoice dilute 50%? No question. That does happen. But when you look at it across a portfolio, this is the result of that from that perspective. Okay, so that's the first piece. That's the quality of the asset. The next question that then comes up is, okay, that's the quality of the asset from a dilution perspective, but write-off. I've heard that in factoring, it has a very high write-off rate within it. We did a study several years ago that was done across the EU platform. And in that platform, they looked at secured finance in total. So receivables-based open account funding where there's security around it. There's some kind of an oversight to it. It's not just a cash flow working capital, but there's security around it. The write-off rate in the EU for the portfolio is about 26 basis points, 0.26%. If you looked at the exact same market without the security, so it's traditional cash flow lending without the oversight, that went up to 0.96%, almost a 4 times worst case when you look at the two portfolios. If you look at each one of the portfolios from higher risk countries, 1.6%, you go to the same countries where there's security, 0.43%. Again, 25% drop from that same country when you put a little bit of security around the transaction. When you look at the lower risk countries, probably hard to see for those in the back, you can see it's 0.32%. So lower risk countries, 0.32%. Again, low risk countries, when you have security around the transaction and operational oversight, it drops from 32 to 9. Great numbers. So again, I'm not a theory person. I want to show facts. And this shows that the quality of the asset within a structured program like FCI retains its asset value, 1. 2 is that when there is a loss, because there is going to be loss, that's what we do here, right? We protect ourselves from risk, and you do take losses. That's the FCI portfolio. All markets, all countries, high risk, low risk. We're in Zimbabwe, the United States, we're at 4 basis points. So even in the best market in Europe, where there's structured finance around the receivables, FCI is a 4 basis point to 26 basis point return. So let's go back to the beginning of the conversation when we talked about an LC getting 50% reserve and open account being at 100%. The question that I asked everyone in the room is why? If we could show this kind of data and statistics, put a white paper together collectively, come back to IPSCO, come back to RBI, show the value and quality of this portfolio, we can take that 95% that's not being funded today to 90%, 80%, 50%. Pick a number as a goal, but it's definitely better than 95%. Again, the proof of this working is look at those markets like a Turkey, like a Chile, different parts of Europe where this has been implemented, and you can actually start tracking factoring against GDP. Today you couldn't do that in India. It would be a rounding error against GDP from an economic perspective. But in countries where they've really matured this product, they start using a percentage of factoring to GDP. And to me, that's my goal for you. That's my ask of you, and how can I help you get it to that point? I want to be able to come back at some point on stage and say, India is now X percent of GDP from a factoring perspective, just like we've seen in other markets. Again, that's a hard, fast number. It's not theory, it's a reality of a number. So just to wrap up in terms of laws and regulations, because that is an important piece to this. As I said, 30-year banker being in front of regulators in the US and in other countries, they need to understand our product and they need to support the product. We should not be afraid of them, we should not run from them. We actually should be one of the first people that we ever talk to and understand and make sure they understand what it is that we do, so that you don't have the issue of LC of open account that you have right now, in the country and in market here. So from laws and regulatory, this is what, sorry, it's a little slow popping up. This is what we can provide within FCI. We're a small team, so what we do is we make sure that we partner locally in market. We find whether it's regulatory bodies, whether it's commerce agencies that we can work with, but we always partner with somebody in market. Great example of that is what we're doing in Africa right now. FCI partners with African Exim Bank. They're a huge partner for us in Africa. I could not do the work that I do in Africa without them, both from just their backing and support, and also from a financial perspective. So my person that operates for me in Africa actually sits in Cairo in an office in African Exim Bank. One, helps me from an overhead perspective and a resource perspective, but more importantly, it gives my person direct access to that African Exim Bank team. And that's what I need, because going into Zimbabwe, it's going to be years before we see the return on that market, obviously. So I need that kind of financial support and just backing to be in the market. And I think in India it's the same thing. We need to find a way as a group, as a team in this room, to figure out how do we come together to provide that support. I'm happy to provide the resources and the framework for it, but we do need to figure out how we put some feet on the ground, if you will, just to really make this successful ultimately. Last one I want to touch on here as I wrap up is, again, success of what FCI has done, where we've partnered with the right global organizations. And in this case, we came together several years ago. UNIDROIT helped us with this, and we put out the model law and factoring. It's not meant to be a copy-paste into any country, into any law system. We know that. What it is, however, is a template that where we've seen this work in certain countries, it can be adopted and put into practice in your country as well. I recently was in Rome with UNIDROIT and with the legal team and going through the model law as it exists today, and we're now in the process of putting together an enactment guide. So it's something that anybody in country can then use. It's a pretty thick manual, but it really walks you through each one of these articles in the law to explain why it's there. And I think that's important because everybody's under a different rule of law. It comes from a different type of a background. So it's important to understand not just a line of code that's in the law, but why is it there, what's it for? So that as you look at that, you can then look at your local regulations and laws and figure out how can that be applied. So this is something that at any point in time, I'm happy to sit down and talk that through with anybody in the room as to how that potentially can assist as well in India. And this is both from an import and an export perspective. Something that caught me a little bit by attention just in the 24 hours that I've been here was a conversation that we were having on the couch this morning before coming in, and how big the import market is in India. I should have known that, I didn't know it, but I've learned it, and there's an opportunity there. I've known India as an export market personally because of the work that I've done over 30 years with transactions that was always coming from India. There's a huge opportunity on the import side of these transactions as well. So putting these laws and regulations in place are extremely valuable to really support the growth of working capital. So one last thing, and I'm not allowed to ever leave the stage without at least putting this up. One of the things that we do every single year is we go around the world and have our annual meeting. So as I mentioned, we're a network, we're an association. which is a legal body. So we physically have to meet once a year in different parts of the world. So every year we move that meeting, and we've divided the worlds up into 3 parts, not quarters, but sections. And this year it's in the Americas, which will be in Rio. In 26, that'll be moving to Lisbon and to Portugal. And in 27, it's still open. But obviously, I can't be influenced. But I think it's important to look at the opportunity that's in the Asian market. And when you look at that corridor that we're coming to in 27, there's a value here. And again, I go back to the proof of what I've seen working in Chile back in 20, 30 years ago, and how they've grown from it. I see Turkey, what they've done. I see the exact same thing here in India. And 10 to 15 years ago, you can see the same thing that happened in China. So you're sitting in an incredible position, an incredible opportunity, and I'm excited about this. I mean, this is what I wake up every day, and the reason that I came back into this after being a banker is to be able to look back on your career and see where you've made an advance in Zimbabwe, you've made an advance in India, you've made an advance in China. That's extremely rewarding. And when you get to sit on the couch like I did this morning for 6 or 7 different people and just really spark ideas of where that opportunity is. We all speak different languages, but we speak the same language of trade. And to be able to sit on that couch and have that kind of an open conversation and know exactly what each other's talking about is it's fun. I really enjoy doing this. So grab me today if you've got a few minutes and want to follow up on this. If not today, I'm always open for video calls as well. I recognize many of you in the room from those video calls that I've had over this past year as well. So thank you again for this, Vayana. Thank you for putting this together. It was just really well done. And again, to have this kind of interaction in the room and the opportunity that you sit on top of, we need to grasp it. So thank you very much.
Thank you so much, Neal, for that very insightful and engaging presentation. May I please call upon Mr. Anthony Rajan, Head of Operations, to please felicitate Neal. As the team sets up for the panel discussion, if anybody has any questions, please.
Again, there's a very selfish question I got from Heather and Ashcraft, right? So what technology, when you do the factoring, helps you, and are you thinking of DLT like what Andrew was saying? Are there any chances, and are you looking at DLTs?
Great question. From a technology perspective, there's so many opportunities that are in the market today. In India, you have multiple fintechs that are really helping connect the seller to the network, and that's the important piece. When I talk about FCI, it's really interesting. So when I came back into FCI at the beginning of this year, I met with the board the year before that and put my strategic hat on as to why I want this job. And they said, this is what we are. I said, wait a minute. You were a fintech 20 years ago, right? FCI used to work off of faxes and telexes 25 years ago. 20 years ago, FCI built the current version of what's called edifactoring, edifactoring.com. And then 3 or 4 years ago, we created edifactoring 2.0. So we already have digitization, right? From a bank-to-bank perspective, whenever I hear people talk about digitization, I sit there and think, I have this, right? From a bank-to-bank perspective, we have complete digital process. There's no paper to electronic. It's going from one bank to another, immediately. However, the opportunity, and I'm speaking to this next week at a GTR event in Dubai with a corporate in the room. The challenge is there. The challenge is at the corporate level, they are taking documents, they are then putting them into an electronic format. In many cases, they're taking them out of an electronic format, and somebody in the trade world is then scanning the PDF to get it back into a system. And then at that point, it finally makes it into my network. So for me, where there's an opportunity, is connecting the trade world, the physical trade world, with the corporates to get it back into the bank. Because many of the banks, financial institutions, they have the ability to take that electronic document and file. And then once it gets into the bank network, in most cases, those banks, whether it's through a SWIFT or whether it's through an FCI, completely electronic at that point. So I'm extremely supportive of digitization. What I'm more supportive of is digital, right? How do we get from going from a piece of paper that we scan to make it digital to where it's, because in most cases, it's already in that system, right, at that point. Great question.
Thank you.
Hi Neil, it's always a pleasure to meet FCI 2 years back. It was here. So just, I'm from the banking side, so we have some challenges we see. Maybe it's an understanding problem. I'm just asking it as a solution for one of them. One is about the capital that Supriya sir mentioned, and you also try to give some address to that problem. So another thing that what we see is basically about the payment is due and it's not happening. And there is a period of 90 days, which is the post that the recovery measures are getting started. But here in India, as well as for the banks and in many parts of the world, I think it's 90 days from that point onwards, the non-performing assets, the classification of the asset as a non-performing kickstarts. So, but in case of this factoring, the thing that saying the 90 days post that, the recovery measures also getting. So we need to wait for that period, even though we have information that the importer, the buyer, there are some issues. So are there any solutions? Because post 90 for banks as a regulator, we are regulated, so that there are so many things, more complexities are coming into that. That is one thing, is a hesitation. This is our understanding. Similarly, some of my other peers also is having the same concern. So is it correct, or are there any other solutions that we can address this particular pain point?
So just to make sure I understand, from mainly focus on the dilution of the invoice once it gets beyond 90 days past due, right? So I think that's where insurance and factoring companies have to continue to work closer and closer together. I think that is a big strategic change that I'm making at FCI. If we go back 10 years or so, insurance and factoring and FCI were viewed as competitors. The reality, we did a study within our portfolio, over 80% of my members use insurance in some way to protect their balance sheet. One of the challenges that we have is that in some cases it has a 180-day window past due before it's resolved, and in others it's 90 days past due before it's resolved. So for me in the short term, my solution is what I mentioned before, that if you have that four-corner model, if you have that local bank, local FI in the market, that process is starting so much earlier. Whereas if you're doing that business direct from outside of the local market, you probably don't notice the problem until it's well past due, right? In other words, you're 15 days past the due date, you haven't received the payment, you reach out to the buyer and say, what's happened? And they said, 60 days ago, I went to your seller and asked for a very simple proof of delivery, a POD, and I never received it. That's the opportunity, is if you have that local bank, if you have that local factor in the market, they're going to be talking to that buyer. That buyer, a month before, is going to say, I need a proof of delivery. That import bank, import factor goes back to the export bank and says, we need this. So to me, the solution is being more proactive in the market than what happens without a partner bank in the transaction. Thank you very much.